Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an incredible show for you this morning, and as always, send your email questions to Brian Rezny at ReznyWealth.com. One of the announcements I want to make before we start going through today's program is we've had a lot of calls from our TV and my radio show listeners. Make sure you do listen to my radio show live on Sunday mornings, by the way, in regards to their portfolio. Obviously, we manage larger portfolio accounts at Rezny Wealth Management, but we're going to help every investor out. We realize a lot of you out there don't have $1 million. We're going to make a special announcement today that effective through the end of this year, 2022, we will reduce our new client minimum to $500,000 and greater to start at Rezny Wealth Management. So this gives you great opportunity to hire a world-class money management firm, and you don't have to have the $1 million to start if your portfolio is down because of the current market conditions. Again, send your questions to Brian Rezny at ReznyWealth.com. I want to start right off today and talk about some of the major mistakes that I find investors make all the time. So whether you're 80 years old, you're 20 years old, you're worth $10 million, or you're worth $10,000, these are mistakes that I see come up often. Again, well-educated people make these same mistakes. Investors who are 70 years old, been investing for 30, 40 years, make a lot of these mistakes. And these mistakes could cost you quite a bit in your portfolio. Number one mistake that we find, especially when people get into those retirement years, is thinking they should be more conservative with their portfolio or being too conservative with their portfolio. Remember, if you're 65 years of age and you're married, there's a good chance of one you living into your 90s. You're talking 25 plus years of retirement. While you don't want to be overly aggressive with your portfolio, you don't want to be too conservative. You still need to make a return on your money so you beat inflation. So again, I often will see people that will call our office, schedule a consultation, and they haven't been happy with their current advisor or firm for conflicts of interest reasons or maybe just poor returns. But one of the things I discuss with every one of those people is the portfolio itself. And I often find a lot of people are too conservative when they should be just a little bit more growth or total return oriented in that portfolio. That can make a big difference throughout that 25, 30-year retirement. Number two big mistake, chasing hot stocks or hot investments after they've already run up. We see this a lot. At the end of every single year, a lot of the publications out there or news services talk about the best mutual fund last year or the number one ETF or the three best stock that performed the most in the previous year. And what do investors typically do? We're all emotional creatures. We tend to gravitate and chase those last year hot investments. I will tell you statistically, investments that did incredible last year often do very mediocre the following year or two. So if you're one of those investors who chased the best ETF last year that was maybe up 70, 80%, all of a sudden you're seeing this year that same investment's down 40 or 50%. So again, don't chase hot investments. Buy investments with research, of good value, and maybe you have a great opportunity then to make money in the future. But don't chase the hottest stuff. It will often burn you the worst. Number three big mistake, falling prey to scams, get-rich-quick investments. Bitcoin is the top of the list. Cryptocurrencies, stay away from this stuff. These are smoke and mirror investments. Other scam investments, in our opinion, are annuities, equity index annuities, sold by all these annuity salespeople at free dinner, free steak seminars. Or the same insurance guy saying, hey, cash in your IRA to buy an insurance policy for free income for life. Not going to happen, folks. There are so many of you, especially retirees, that we see every day that get taken advantage of by the annuity sales guy who says he's a fiduciary and he's not, who basically tells you, oh, you can take money out of your IRA tax-free. You can't. But they're going to sell you an annuity-based product or an insurance product. These are some of the big scams next to investments like cryptocurrency or Bitcoin. Buyer beware. Mistake number 4, trying to time the market. I know nobody ever wants to see their $1 million go down 10 or 15%, but folks, reality is this. If you try to time the market, get out at the top or buying at the bottom, you're not going to be able to do it. There are study after study for decades and decades that show investors basically make bad decisions when it comes to timing. So what you want to do is properly diversify the portfolio. If there's asset categories or sectors that are grossly overvalued, you trim those and take profits and move on to greener pastures. But to think, hey, I heard there's a recession. Should I time the market and get all my money out? Remember, look at this year alone. The bond market is actually, a lot of the bonds are actually down more than a lot of the equity indices year to date. So people say, I thought bonds were safe. Well, they can be as risky as equities depending on the cycle. So remember, all investments, bonds, stocks, real estate, oil, gas, all these different investments all have volatility. Building a quality portfolio based upon research and buying investments that are not overpriced or overvalued is a great opportunity to grow that portfolio over the longer term. And remember, whether you're 40 or whether you're 85, you're a long-term investor. Long-term investors are investors who the majority of your money is going to be invested at least 3 years or more. So if you're 75 and you have $1 million portfolio, think about this. The majority of that money isn't going to be spent in 3 years. You're going to spend a little bit of it. The majority of that money is going to be around 3 years, 5, 10, 15 years, even if you're 85 today. So remember, long-term investing is 3 years or longer. Have some safety, more safe, secure investments for that shorter term income need for the next 3 years. But the majority of your money should be pushing hard in order to make a quality total return. Mistake number 5, making emotional decisions. This is a big one. 90% of investor failure, whether you're working with a money manager, whether you're managing your own money, is your own emotion upstairs. Nobody, again, ever wants to see their money go down 10 or 15 or 20%, but unfortunately, it does happen from time to time. Statistically, we have a pullback in many investment sectors every 20 years, 20% every 3 years. Think about that. Every year, we get 10 to 12% pullbacks in most investment sectors. And by the way, that includes bonds that are supposed to be a safe investment. Investments have normal volatility. Reacting emotionally, looking at crazy newsletters or reports in your inbox how the world's coming to an end will often cause people to make emotional investment decisions, which again will be detrimental to your overall wealth and something you need to avoid at all costs. Mistake number 6. Wall Street asset allocation over diversification. Many of you suffer from this. If you're working with any big bank or Wall Street style firm, you're probably involved in what we call asset allocation and over diversified portfolio. While it's important to be diversified properly, owning 1% of an ETF that has a bunch of diversified investments or owning 42 ETFs and 15 mutual funds and 82 stocks, what you're doing is you're watering down the good stuff with the mediocre stuff. I will often hear from people that hire our firm. I talked to our advisor for years. I said to them, why do we keep owning Europe in the portfolio? It hasn't done anything in 10 or 15 years. And the advisor at the big Wall Street firm will say, well, we like to spread the money out everywhere because we don't know what's going to really happen. Folks, at the end of the day, don't own investments that really have no opportunity to grow and clearly are taking the same risk of assets that have a chance to grow, but really you're investing just to spread it out everywhere. Over diversification, asset allocation, that pie that you see on your brokerage statement that has all these different broke up parts, some are 1%, 0.5%, maybe some are 3%. If an investment's that good, why do you own 1% of it? Doesn't make a lot of sense. Mistake number 7, entrusting your life savings to a salesperson, a so-called advisor. Remember, the only kind of firm you should entrust your money to is what's called a fee-only fiduciary money manager. There is no bank, no insurance company, no advisor, no vice president at that Wall Street style firm that is a fee-only fiduciary money manager. None of them. Mistake number 8, and probably one of the biggest mistakes overall, is not checking out the firm or advisor you entrust your money to. You can easily go to FINRA or the SEC site to get information about the firm you entrust your money to. Why would you hire the big bank that was fined $2.5 billion in the last 3 years alone for misdoings against their client? You probably didn't know that happened. You can find out if you check the FINRA site and SEC site. You should never entrust your money to a firm that's been fined multiple times, especially for billions of dollars. If you go to ReznyWealth.com, scroll to the bottom of our homepage, you can download for free Real Advisor, Fake Advisor, and it lists both the SEC site and the FINRA site, how to check out the firm you entrust your money. I'm going to go to a quick break. I'll be right back with more questions after this. Make sure you do visit ReznyWealth.com and send your questions to Brian Rezny at ReznyWealth.com. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 investment risks you must avoid now. I hope you're enjoying today's program. As always, send your questions to Brian Rezny at ReznyWealth.com. You know, we talked about some of the big financial mistakes that investors make. Again, whether you're a seasoned professional, whether you're 85 or 20 or 25 or somewhere in the middle, whether you're conservative or aggressive, whether you're self-managing or maybe you have a so-called advisor and not a real money manager, often investors make those mistakes. I suggest you learn from others' mistakes. It's less costly to you. Josh in Bonita Springs, Florida. I'm thinking about investing in ETFs and was wondering if you had any good recommendations on emerging market ETFs. Folks, first off, an ETF is what's considered an exchange-traded fund. There's literally thousands of ETFs today, and what an ETF essentially is kind of like an empty cup. And it's what you put in the cup. So you could buy an ETF that owns the S&P 500. You could buy a cup that owns gold or currencies or emerging markets. Josh, what I'm going to say to you is this. Instead of giving you an ETF that I think you should invest in the emerging markets, I'm going to say do not invest in the emerging markets. Right now at Rezny Wealth Management, again, our positions can change at any time. We currently have nothing invested in the emerging markets and or Europe. Our investments right now are in the United States, whether it's bond related or whether that's equity related. And why is that? Because we do a lot of research on the macro first, the big picture. The U.S. can right now, at least for the rest of this year and probably well into next year, in our opinion, is going to be the best place to invest. The emerging markets right now are just way too risky. There's just a lot of issues going on, not only with debt, but with overall slowdowns. And these economies ultimately, especially with the strong dollar and other things that are going on, in my opinion, you need to avoid emerging markets at all cost and the overall Europe markets at all cost. I think there may be times down the road, but it's not going to be this year, and my guess is it won't be next year. We actually haven't owned emerging markets for many, many years at Rezny Wealth Management because they haven't been good places for return. The risk has been heightened, and I think you should avoid those also. Barry in Tampa, Florida. Is now a good time to sell stocks, and are we headed for a recession? Barry, generally speaking, what I would tell you is this. I'm not going to tell you just to go sell your stocks. It depends what stocks you own. Maybe some of your stocks you should sell if they're not appropriate or you need to upgrade your portfolio. But as for recession, clearly the economy is slowing down somewhat. I do not see any major recession like what we saw in the boom of the housing boom and bust in 2007, 2008. I do see a modest slowdown from all the stimulus wearing off and the higher recessionary numbers, which are starting to look like they're abating, especially on the manufacturing side. So what I'm going to say is this. Expect somewhat of a mild recession. I think the equity markets already have that priced in. If things do get more severe, we could definitely see more of a pullback in some of the equity markets. But generally speaking, look at your portfolio. If there's things you shouldn't own, yes, those are things maybe you want to sell and upgrade that portfolio. But just a whole stock portfolio, because fears of recession, what you're now doing is timing the market. When do you get in? When do you get out? You're probably going to make both those timings mistakes wrong. If you're looking at the longer term, the next 3 years or longer, I think you're going to be a happy camper if you own the right stocks and or the right investments in your portfolio. Phil in Punta Gorda, Florida. What do you think about Ford stock given their push into the electric vehicle market? You know, Phil, that's a great question. What I'm going to say is this. Every car company, everyone, it all has a push into the electric car company. Think about this. And I'm just going to use this as a number. Let's say worldwide, there's approximately 10 million cars built every year. And right now, those are all gas cars. So let's say Ford and all the other car companies start building electric cars and they stop building gas cars. Are they going to build more than 10,000 cars a year because that's all that's needed, or 10 million, excuse me? No. Whether they build 10 million gas cars, whether they build 10 million electric cars, you're still only going to build 10 million cars because that's all the demand that is necessary for the world. So Ford's not going to make any more money. They're not going to make any less money by having electric cars. Ford stock, while I think it's a good company, I do not think it's a great investment. But what I'm going to say is this. If you're getting into the cyclical stocks like an auto company, you typically want to buy those when the price is significantly down. There's fear in the streets of recessionary talk, kind of like we're seeing on the Ford price today. Often that's when you do want to buy stocks like that are cyclical in nature. They're already pricing in a recession. The world's coming to an end, which I don't think it is. And then what you do is you own those and you trade those maybe over the next 12 to 18, 24 months as prices come back. But these are not long-term investments. Kind of like airline stocks, same thing. You really don't want to buy them in general. There's better places, ultimately, in our opinion, to put your money. William in Inglewood, Florida. I have 3 annuities I bought 5 years ago. I was told 7% return guarantees and no risk. That has not happened. I still have 7% surrender penalties. What would you do with these? I feel I was misled and ripped off by my advisor. Help. William, you're like probably 99.99% of people who were sold annuities. People buy annuities because they give you a really good sales pitch and probably mislead you. And I do see a lot of lying from these annuity people. Annuities are crummy investments that should never be bought by any investor. But unfortunately, there's a lot of annuity sales people that make these things sound better than they are. If you buy an equity index annuity, plan on making maybe 1% annualized returns over the next 10 years. That's it. You'd be better to go to the bank, buy a CD so you don't have big back-end surrender penalties that maybe are 10 or 12% that last 10 or 12 or 15 years. There's no free lunch when you buy annuities. You're going to get low returns. You're not going to make 7%. You're not going to make stock market returns. There are cost structures to all of these annuities, so don't be lied to again by the so-called advisor. You're insanely locking your money up with limited liquidity when you buy an annuity for multiple years, sometimes a decade or longer. Annuities are just complete junk, should never be in a portfolio. If you want to be conservative, you're going to make conservative dollars or returns, kind of like a CD. So what I'm going to suggest to you as an investor is instead of buying an annuity, never buy one. If you do own them today, what you have to decide is, should you get rid of them now or get rid of some of them, even if you did incur the penalty? This is something you're going to have to decide for greener pastures. Because if you keep the annuities until the penalty is completely gone and you don't make any more money the next 6 or 7 years, you're that much further behind. So again, by keeping the annuity, it could make the problem even worse and worse and worse. And that's only a decision you ultimately can make if you're willing to accept a penalty to get all your money out. Make that decision. You can always call Rezny Wealth Management if you're looking for real money management and real advice without the heartburn of the annuity or insurance person that's trying to basically pick your pocket 100% of the time. Larry in Fort Myers, Florida. I'm getting ready to retire and I have $2.8 million. I am not happy with my current advisor. No communication, poor returns. Are you taking new clients? Larry, yes, Rezny Wealth Management is taking new clients. And what I would suggest is you call our office during the week. One of the comments I will make, though, Larry, is I hear this from a lot of new people that hire my firm. You know, once the investments were sold to us by the big Wall Street firm or bank, we never seem to hear from the person. There's never timely portfolio changes made. We don't really get communicated to. The only time we hear from them is when we call them. That's not correct. Ultimately, you know, managing money for over 35 years, we believe that our clients not only should be well taken care of on the money management side, but you also have to be equally good at communication with the client. If you communicate well with the client, they get that comfort factor and they realize you're doing the job you're supposed to do correctly. And they understand where they're at, so they can make better decisions around their money and not really get nervous and all the other things that happen when you have bad client communication from one of these big firms. Call our office. You can also visit ReznyWealth.com. The other thing, Larry, I would suggest, and I talked about this earlier, when you go to ReznyWealth.com, scroll to the bottom of our homepage, download for free Real Advisor, Fake Advisor. It'll talk about how to interview a new advisor and how to check out that firm through FINRA or the SEC site. It's an invaluable tool for every investor, regardless of age and regardless of portfolio size. I'm going to take a quick break. When I come back, I'm going to take more questions, so send those to Brian Rezny at ReznyWealth.com. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Folks, I hope you're enjoying today's program. And as always, send those questions to Brian Rezny at ReznyWealth.com. We're taking your questions. We want to make sure we keep you on track. I think the most important thing that we're talking about on today's show is really avoiding those investment pitfalls, those emotional decisions that unfortunately hit a lot of investors and cause you great harm. You know, I'll tell you a sad story that is reality, unfortunately, for too many investors. We'll have people that will call our office. They've listened to my show for 6, 7, 10, 15 years maybe. And they'll say, Brian, I've listened to your show for a long time. We kind of procrastinated calling your firm for a consultation, you know, because everybody's busy. But they said one of the sad things that's happened to us is not only were our returns lousy, but we were sold a lot of investments we probably should have never bought. We listen to your show often, but we still own these investments, and they're proven to be the wrong thing for our portfolio. So what I would suggest to every investor, if at all you're second guessing that relationship you have, call a real firm to help manage your money. You need to find yourself a fee-only fiduciary money manager like Rezny Wealth Management. We love helping out new clients every day. Call our office during the week. We'd love to get you in as part of our client base. Keith in Punta Gorda, Florida. Absolutely love your Sunday morning show. I'm not a gambler in straight stocks. What do you think about the risks of Bitcoin? Keith, don't touch Bitcoin. Don't touch cryptocurrency. Bitcoin is smoke and mirrors. You're buying nothing. Bitcoin is touted as an inflation hedge. Guess what happened with Bitcoin this year? It's down 60% and inflation's raging, the highest inflation we've had in 40 years. So if it's an inflation hedge, but Bitcoin's down over 60%, that doesn't sound like an inflation hedge to me. It's supposed to be an alternative risk asset to the stock market. Wait, it's down triple what the stock market is or more. That doesn't sound like a different asset, a risk profile. It sounds like a riskier profile. Bitcoin is smoke and mirrors. No investor should be buying cryptocurrencies, period. Cryptocurrencies will be utilized by governments around the world one day when they have their own stable, essentially cryptocurrency, a way as payment means. But buying Bitcoin or cryptocurrencies as an investment, it's pure speculation. You're going to risk the house. You'd be better off buying $10 worth of lotto tickets and probably have a better chance to make a return on your money. Mike in Naples, Florida. What do you think about life insurance for an IRA for a lifetime income? Mike, it sounds to me like one of these charlatans that calls himself an advisor got a hold of you at a free steak dinner seminar. First off, you cannot put an IRA into an insurance policy. It's a prohibited transaction by the IRS. I'll tell you what's happening. That so-called advisor is trying to talk you into, oh, you can move your money to an IRA or your IRA into an insurance policy and not pay any taxes in the future on income you take out. A complete lie. First off, the way this works is, or the way the scam works, the so-called advisor talks you into buying an expensive insurance policy you don't need. You have to cash out your IRA, pay tax at probably a 40% bracket, meaning you have 40% less to go into the insurance policy. So when the money then goes into the insurance policy, you've already paid full taxes. So if you pull the money out of the insurance policy, well, guess what? You've already paid tax on it. Of course, you're going to get tax-free income because you've already paid tax on your IRA. So, Mike, as I've suggested, never buy an insurance product for an IRA. You're retired. You don't need an insurance product. You're going to get ultimately ripped off and you're not going to be happy. Robert in Fort Myers, Florida. Do you use charts? Are stocks overbought based on technical indicators? We do use charts at Rezny Wealth Management. We do fundamental analysis, which is lifting the hood, looking under all the bells and whistles and doing all that kind of good stuff. But we also use charting, which is, again, another useful tool when you're managing money. It helps you look at, generally speaking, overbought, oversold conditions. It's great for maybe you want to take some profits on a position. Maybe you want to add a new position. Maybe you've got some extra cash that needs to go to work and you're kind of waiting for a slight pullback. You can look at charts and use that. It's not perfect, but it definitely is a useful tool in the toolbox when you're managing portfolios. In addition to fundamental analysis, technical comes up second, and we do enjoy using it quite a bit. Gary in Fort Myers, Florida. Do you know where I can invest somewhere, say $200,000, get 4 or 5%? In a safe return like a CD account, looking for something safe? Gary, no, there's nothing you can buy that's going to be safe that's going to pay you 4 or 5%. If you want to get safe money, go to the bank, buy a laddered CD approach. A 1-year CD for half the money, a 2-year CD for the other half. When the 1-year CD comes due, put it back into a 2-year. You'll have a CD coming due every year then at that point. You'll make 1% today, maybe a little bit better. That's it. There is no safe money at 4 or 5%. If anybody tells you that you're going to make more than 1% safe, they're ultimately lying to you. Go to the bank, call it a day. And one of the things I stress to every investor, there's no magical investment that is safe going to give you high returns. It's not going to happen. And if you get suckered into an investment or talk to an investment that claims that, I'll guarantee you in 3 years you're going to figure out you were taken to the woodshed. Folks, I'm just about out of time. If you're tired of bad advice, poor client communication, and feeling like your advisor just has given up the job and not doing the right job for you, it's time for a positive difference. It's time you call Rezny Wealth Management for real advice and real money management. One of the comments I always get is we should have called sooner. Honesty, integrity, compassion, and competence is the difference Rezny Wealth Management provides every one of our clients. Again, don't wait. If you're unsure about who you're currently utilizing for your portfolio management, or maybe you're doing it yourself and you're just not happy and you're looking for a real money management firm, call Rezny Wealth Management or visit our website, reznywealth.com. That's reznywealth.com. We'll see you next week.